what is the Warner Brothers stock price target? We're going to conduct some Warner Brothers stock analysis today to try and work out exactly what that should be. Yes, we know what the analysts predicted, but we're going to actually have a look at some of the reasons as to why the stock has fell so far since it spun out of AT&T, and then we're going to have a look at what the relative upside is for Warner Brothers stock going forward. Bearing in mind it is early days, they've only just released their first quarter earnings, their first one ever. They've only just spun out of AT&T. The dust is yet to settle, and they need to start quelling some of the projects that have been siphoning off an awful lot of money previously. So they need to get their feet under the table and actually start off as a company. So we're going to take a look at that today, and then ultimately we're going to have a little look at what the price target will be round about the end of 2022 and into 2023, and then onwards from there. We've got to allow time for the dust to settle. So if that sounds like something you're interested in today, guys, do please smash that like button, consider subscribing to the channel, and let's get in there and take a look. Hey guys, welcome into the video. So here we are on the landing page for Warner Bros stock, and here we have the share price at $18.96, an absolutely insane fall even just over the last 5 days, since it was at a high of $23.22, and it actually got up to $26 immediately when the share price actually started shares started to float properly. The market cap is now $48 billion. So if you got in right at the start, there's been a little bit of downside to your investment so far. However, there are certain things to look up to on this one, and it is really interesting to see this company go forward. Now it is finally spun out of AT&T. So analysts reckon that there is a price target of $35.88 and rate it as overweight overall. This is very early days for the company. It's actually got to start delivering on its own now instead of being in the shell of AT&T, and I'm extremely interested to see just how well they do now that the stabilizers have come off. So the current targets are a $10 buy rating, 1 overweight, 11 as hold. The high analyst price target is $52. That'd be a huge return on your investment from where the current price is. A median of 40 and a low of 20, which will actually now below based on the current share price. Give this company a chance to actually pay off some of the debt that it inherited from AT&T when it generates its cash going forward and generates its revenue going forward, and it will become highly profitable. And that is what some of these companies have got out. So shares have fallen since its listing because the CFO has warned on the actual profit that the company's made. As I've already said, they get their feet under the table and they start quashing projects that were just silly and actually streamline the business to actually start delivering what they said that it would. So a simple example of this would be CNN Plus. That was only live for just a couple of months, cost millions, tens of millions, if not hundreds of millions of dollars to set up, and then Warner Media and Disca now own it, and they've just shut it down straight away because it was a complete waste of money. There is no return on investment in. Most people get their news from open sources, so people aren't going to pay extra for CNN, and that is exactly right. Most people see this company competing as a streaming giant with the likes of Disney and Netflix and Paramount, but it also has, a bit like Disney, other sources of revenue in the playbook rather than just Netflix being on its own. If you look over the recent earnings call from AT&T and the recent earnings announcement from Warner Bros stock, you can see that the company actually added 2 million paying subscribers in the last quarter, for now a total of 24 million, which is consistent with what it had last quarter. Last week AT&T reported that it had 76.8 million subscribers, and that is factoring the same sort of macro environment that Netflix is having to deal with and all the other streamers are dealing with. And there was also a nice 13% revenue jump in that case as well, which is also why I like the look of this company going forward. 4 reasons to like the stock right now, according to the Motley Fool. It is a potential streaming giant. We've already seen this, and it trades at a relative discount compared to Disney and its Netflix peers. Netflix trades at about 18 times, and Disney trades at about 14 times, and currently Disca and Warner Bros are actually trading at about 8 times. So there is serious potential for significant return in this company, although I understand that, of course, they've got to pay off that debt burden that is over the head. There's room to improve the cable and network business, and they're going to achieve some synergies by just becoming one company. So Discovery merging with Warner Brothers, getting all that good stuff all in one place will be really, really good for the company going forward and help it become the streaming giant that it could be. And this alludes back to what I was actually saying. Disney trades at 17 times its EBITDA and Netflix trades at 14 times, and yet Warner Bros only trades at 8 times at the moment. So that is a significant discount for you to have. And this is what we've been talking about, guys. It has a 200k hours of video content. All of these brands here for it to get out to the rest of the world. It still hasn't spread out to the rest of the world yet. So there is still untapped potential there. And obviously potential to still carry on growing across the US and Europe as well. It has a really good global linear business, and the financial highlights are that obviously we've already seen this now. This is the sort of revenue they could expect in 2023 and EBITDA. That's been revised slightly downwards now based on the profit warning that we had from the CFO yesterday, but they're targeting an awful lot of revenue in 2023. It'll be interesting to see if they start delivering on this. If they start achieving this sort of revenue or close to it, this sort of EBITDA, although it has been revised slightly downwards, and start deleveraging the debt that they've got, then that will bode extremely well for the company going forward and have a very positive effect on the share price. I would genuinely, in my opinion, and I'm going to be buying shares in this company. I got my free shares from AT&T, but while the price is so low, I'm definitely going to add to my position. You can see that the financial highlights for the first ever quarter here were revenue was up 13%, advertising was up a little bit, total income was 1 billion. They did do pretty well, but they just obviously have had to take into effect some of the costs of the projects that have gone wrong, CNN Plus, and the macro environment that I've already talked about as well. When we hark back to what the analysts think of this company, I 100% come in and swing in behind the higher sort of valuation, $52, $60, $70. If it can start deleveraging that debt, carrying on growing the revenue and carrying on growing its EBITDA, then it can definitely 100% get to that sort of price and compete with the sort of multiples that Netflix and Disney is at. Even though there's been a massive sell-off in Netflix, it is still quite highly valued, and this is the sort of thing that can definitely happen to Warner Brothers stock, and it has extra things in the playbook. As we've said, it has the Harry Potter world, it has an extremely large library of sports, it has the movies, it has Harry Potter, it has Game of Thrones, it has all of that sort of things. The new Game of Thrones, or the prequel to Game of Thrones, is due out soon, so that will have a positive effect and will contribute in to what is going to be the growth of HBO Max. That is going to be the kicker, and it's going to be a significant amount of revenue, but it's not the only revenue that this company can get. It has attachments in theme parks, it has its own Warner Brothers studio tour here in the UK and also across the world. There's fantastic potential in this company, and at the simple $18 that it's currently at, that is an absolute bargain price, guys, make no doubt about that. To reiterate then, guys, I agree with the higher analyst estimates for this company, $52 to $70, as long as it starts delivering on reducing that debt leverage that it's got, as long as it continues to be profitable, even though we've got a reduced profit at the moment for this quarter and probably the next coming quarter as the macro environment develops, and the revenue growth continues as it has done for the last quarters in the shell of AT&T. Once it starts getting its feet under the table, it gets rid of the rubbish projects like CNN Plus and starts disbanding all of them. Yes, there's going to be some money lost, and we will feel that over the first couple of quarters while the dust settles, but as we get out towards the end of the year, quarter 4 2022, quarter 1 2023, that will be when we see some significant movement in this share price, definitely up towards $40, $50 in the bullish case, especially if streaming as a whole gets a bit of a tailwind back from with the likes of Netflix and Disney recovering, then this share price could definitely hit $70 and provide a 3 times return on your investment if you were to get in at today's current prices. Thank you very much for watching today, guys. Absolute pleasure as always. Catch you in the next investing episode.